What's up, everybody? Today we're going to analyze Intel Corporation. Somebody requested this in the comments, so that's why we're going to check out Intel. Now, it is a chip manufacturer, and chips are not really my forte. I don't like, okay, I can look at numbers and whatnot, but I don't know what specific chips do, and it's hard to project sales of chips going into the future, especially with different competitors. I'm not quite sure what the direct competitors are for all the different products that Intel has. So that's why it's kind of difficult to value these types of companies, but we're going to do our best. So for the past 5 years, Intel has underperformed. They're down 20% in the past 5 years, whereas the S&P 500 is up like 80%. So not the greatest. And over the all time. They had their peak in the dot-com bubble, and actually, they never recovered to their peak in the dot-com bubble. Actually, kind of reminds me of like Nvidia right now, except instead of a dot-com bubble, I kind of see it as an AI bubble. But yeah, that's the all-time chart, the 5-year chart. They're down. So is this a buying opportunity? And that's the question we're going to try and answer today. They are a $180 billion company, definitely a large company, and their price to earnings ratio right now is 110, but that's kind of misleading. Let's check out their actual numbers here. Statements, and we're looking at their total revenue. I'm going to zoom in on this. Here's their revenue yearly, 62 billion up to 70. At their peak, they got 80 billion in 2021, and then it's been a sharp decline down to 54 billion. Not quite sure if that's due to competition with like AMD taking over some market share, or if that's just because of the cyclicality of the chips business. So not quite sure about that. And then we also have their income. So their income really dropped off a cliff. Looking at their operating income, this line right here, this is their operating income. And we can see that when their revenue is really high, at like 80 billion, then their operating income stays at like 20 billion. But then since it dropped by 17 billion here, their net income or their operating income dropped like off a cliff. And so they basically are making like no money right now. Um, except for the last quarter. The last quarter they actually had operating income of 1.4 billion, and annualize that, that's 6 billion. So 6 billion is at least better than nothing, but it's still not quite back up to their original levels. One other thing I wanted to note is right here. So they had operating income of 1.44 billion, and then they had a non-operating income as well. And if we look into this, we could see 915 million for interest, and then they also had like an unusual income, which is sort of odd. The reason why actually has to do with this. Right here it says in Q4 we also recognized 845 million of advanced manufacturing investment credits. So they literally just got free money from the CHIPS Act, and that shows up in their income statement, really juicing their numbers for last quarter. Let's go to their balance sheet here. They have 24.66 billion in net debt, which is kind of high. And in the last year, they actually added like 10 billion into their debt. So not quite what you'd love to see. 24 billion still isn't like insanely high. If they can get back to their previous numbers, then they could pay that off in a year. And then cash flow, we check out their cash from financing activities, and they actually issued shares. They issued $4 billion worth of shares last year, and they paid some dividends. So let's go to this sheet now. Okay, this is their off their slides. Q4 beat on revenue. They're reestablishing technology leadership. I'm not say like what are all these different chips? It's very confusing to me. And then we've got executing strategy to bring AI everywhere, and they have to mention AI because AI is all the hype right now. Launching Core Ultra AI PC and fifth generation Xeon, the unquestioned AI CPU leader. So I guess that might encourage more growth in the future. We'll see about that. I'm not quite sure. Because we can actually see some of their segments. So they're up 10% year over year with their revenue. So not even like, I mean, they're up, but they're still not nearly close to their like all-time highs in revenue. So here's their segment. So they actually had the largest jump in revenue from their client computing group. And I'm not quite sure what that is, but I'm guessing that's their Intel Core i processors that they put in most computers. And then we've got their data center and AI group. It actually declined by 400 million. So they say that this is driving growth, but it's obviously not. Um, yeah, kind of misleading there. And then we've got their network and edge group also declined. And then they increased in their foundry services. But the increase here, right? It's a big increase year over year in terms of percentage, but in terms of the actual number, the number is kind of low. So they added like 120 million here, or 113 million here, but they lost 400 million here. So like once again, kind of misleading. Like, oh yeah, up 63%, but yeah, it doesn't make that big of a difference. It really doesn't. So, and then their outlook is for 12.2 to 13.2. Not quite sure why it's a $1 billion like why can they not be more precise with their outlooks? I'm not quite sure, but yeah, they're projecting like up 8% year over year, and then a 45% gross margin. And then we've got their Yahoo Finance estimates 1.34 for earnings, up to 2.24, which is that's like a 80% increase, which is insane. But also you got to look at their low estimate and high estimate. Low estimate is 1, and then high estimate is 3.15. So crazy difference in low and high estimates. And then the revenue estimate, we've got 57 billion going up to 64 billion in the following year, which is like a 12% increase. So I put this stuff into my DCF model. Let me zoom in here. And I put the EPS estimate, revenue estimate here. They've been doing like 12 billion. Well, actually, they didn't do any buybacks, so let's get rid of that. And then their net debt of 24 billion. I wanted 10% returns, so that's why I have a discount rate of 10%. And an exit multiple of 20. I think that's fair for Intel. It might be even better to go lower because they're kind of a legacy maker. Not quite sure if they've got a lot of innovation, but it's like according to their slides, they've got innovation in spades. So we'll just go with that. And then for 2024 growth and earnings, I put 35%. They're projecting like a 80% growth. I cannot bring myself to put that in there, so I just put 35%. And then 2025, 10% growth going from there. I think that's optimistic, but well, really this earnings model is tough because their margins have been suppressed for so long, so it's tough to use this earnings model. It's better to use this revenue model here, and they're projecting 12% growth into 2025, so I put that there, and then 10% growth, and I have them growing every single year. It's definitely possible that they grow more than this. It's definitely possible that they grow less than this. They could have some negative years of growth, but I think on average this would be fair for Intel in terms of growth. Now the tough part here is profit margin. And over the past like okay, back when they were at their all-time highs and they had high profit margins, they were doing like 22% in profit margin. But since then it really dropped off a cliff. And even last quarter they had We can go to stats. Last quarter for their net margin, they had a 17% net margin, but you got to remember that was juiced up from the CHIPS Act, and really their net margin would have been closer to their operating margin at 9%. So you can't really look at the net margin uh, as a real number. The operating margin is closer to what it should be, and you can see it's been negative in some of the quarters last year. So 10% margin, can they get that up to 20% again? And that is a question that I don't know the answer to. So, wait, can you guys see that? Oh shoot, my bad, guys. My bad. My bad. This is their operating margin by quarter, 9.3%. I'm so sorry about that. Okay. But yeah, we're up to 9.3%. And for operating margin, you want to look at that instead of net margin. Then back to the model. And so I put a 10% profit margin for all these years and continuously into the future. If they've got some competition, then I think 10% margin is fine. They could also go lower than that, and they could go higher. They could get back up to 20% if possible. I don't really see them ever going above 20%. And then revenue growth, I think that's fair, of course. But if we assume that these numbers are correct into the future, then their fair share price is between like 22.73 and 28, which is much lower than their current price. But if they can get their profit margin up, which I think is kind of unlikely, but let's say that they get their profit margin back up to like a 20%, then they are in the green. And like I think this is a rosy picture, right? And then the fair share price would be about $47 to $53, which is a discount on the current price. And you'd probably be expecting like a 10% return, 12% return maybe. You'd probably expect like a 12% return if this scenario plays out. But for me, I don't really see it playing out like this. So that's the reason why I'm going to stay away from this chip stock. But yeah, you guys might think differently with their new AI chips. And if you know more about the chips market, then you might know if they're going to sell well or not. But for me, it's really hard to predict the future. So yeah, if you guys like the video, hit that like button, and I'll see you in the next video.